Welcome everybody to our November webinar, Verivest webinar. We've got an exciting topic today, and so I'll send it to Matt. Thanks you.
Thanks, Kylie. Appreciate you putting everything together as always. Do a great job. So thanks for all the behind the scenes work. Much appreciated. Um, Excited today to have a guy that's been in the business for a long time. Known him for quite a number of years and crossed paths in the mortgage pool space many times. And should be an interesting conversation. We're going to kind of go a little bit all over the place, but learn a little bit more about today's guest, Anthony Geraci. Anthony, welcome.
Matt, thanks for having me. Excited to be here.
Yeah, it's great to have you. I appreciate it. So I just kind of started. Love to hear a little bit about your story and background. I think a lot of people in the industry know who you are, but it's been kind of an entrepreneurial journey. I know from the legal side to the fund manager side to the conference side. Done a lot of stuff. But kind of, why don't you start just sort of how'd you get in this business? I know long ago you worked for another law firm, kind of went out on your own, but kind of give us a little bit of background and for kind of frame the conversation.
Yeah, absolutely. I always say I kind of fell into the space so to speak, and it's been quite the journey since then. But yeah, as you said, I graduated law school. I went to Chapman in Orange County, California, and as I started looking for jobs, I knew I wanted to be in the real estate industry, and there was this job offer for mortgages, and of course, got the job with the firm. I stayed there for a couple of years, and really learned private lending, the ins and outs. Of course, back then, Matt, as you know, we're both old enough to say it was hard money lending back in the day.
Exactly.
There's a change, a nomenclature change about 20, 15 years ago or so, and now it's all private lending. But yeah, back then, of course, you had it's just a fractional framework, which was so crazy. Most people stayed in the states in which they were at. And fast forward today, as everybody's in 50 states and really trying to have that framework of lending in any state is definitely something new. So I launched my own firm, Geraci Law Firm, in 2007. We grew pretty quickly from there. And it's funny, we grew during that subprime crisis. If you guys remember back in '07,
Oh
and
yeah.
we just had a
Oh yeah.
lot of, yeah, right? The mortgage implodometer, I will never forget ever in my entire life, where you say something like Lehman Brothers, a 100-year-old institution, just goes bankrupt overnight. It was just insanity back then. But we grew during the crisis, if you will. We had a lot of mortgage fund clients, really battle tested a lot of the offerings, and I think we'll talk about even REITs or mortgage funds, whatever, because that's really where it comes down to is times are good, they're great, but when things happen, everybody gets unhappy and starts to sue. In 20, and also around that time, in 2009, I founded the American Association of Private Lenders. So that's an association for private lenders nationwide. And then in 2015, started my own conference line, JurassiCon, if you will. And our goal really was to kind of unify the industry, if you will, right? Try to get people networking. We kind of rode the wave. I don't want to take all credit for it. There were some seeds of people just getting started and exposed to the space. What was this
Yeah.
oh no, hard money lending is something bad. And the zero rate environment of the 2010s, I'll call it, really people started to get attracted because you're getting double digit returns on a very little risk for backed by real estate. This became, of course, now as we know, if you will, securitization, RTLs, all that stuff that's happening today. Those were the seeds of that back then.
Yeah, let's talk about that real
Yeah,
quick on the
please.
conference. I mean, we put on a bunch of conferences throughout that similar time period, and we had a certain format, and so I mean, we've done the conference gig, and it's a lot of work. Like, what prompted you to kind of do that in the first place? And were you doing that to sort of earn revenue off of it, or are you just did you guys make any money on it? I know we really never did.
No.
I mean, what was the motivation, and like, how did that go?
Yeah, it was never, and it still is, and never will be probably a moneymaker, right? I mean, we'll make a little bit. And by a little bit, I don't mean like millions. I mean, we're talking about, low five, six figures. And the whole goal was never to make money necessarily, just break even. My goal
Yeah.
was though to have a space for the industry to come together and, people who service the industry, well, for lack of better, vendors, right? And lenders and brokers and everybody could come together and do deals together, right? My theory was, hey, if my clients grow, I'll grow as a result. And we did, right? Through the 2010s, 2020s, we grew rapidly as a result of that. So that's always been my thought is how do I get my clients together, the industry together, and get them talking about what they want to talk about, right? Whether it's securitizations, whether it's brokering, niches with balance sheet lenders, what have you.
Yeah, and so like I know somewhere along the way, so you started off as graduated law school, started off on the legal side, kind of got into the private lending space, and ultimately, I know you guys did a lot of fund formation work, right? Helping people kind of go from doing it on the fractionalized model to doing it in a pooled investment fund. So a lot of that for you came on the legal side initially, but eventually, at some point, my understanding is you launched your own fund, and it's not necessarily a real estate fund, but so you at some point you became and are still, I think, right, a fund manager. What were some of the things that like you thought you knew as a lawyer, when setting up the documents, but then once you became a manager,
Mm-hmm.
you really learned, on the job? Because I know there's a difference between sometimes theory and reality, and like has that helped you become better on both sides, and just kind of what was that experience like?
Uh, in one word, absolutely, right? I mean, I like what you said, theory, right? Because that's really, as a lawyer, I know how to structure them. I understand the logic behind them. I understand why they're there to protect what have you. But as you know, Matt, you've run several funds yourself. There's a difference between, hey, I've created this document for you. Here's your rules. Go forth and go run it, and actually running the fund, right?
Yes.
And then, because it's another business, if you imagine, right? Not only do you have the origination shop that you're doing, but now you've got this fund, right? And you've got some teeth in it, in that you've got investors, right? You want to make sure they're taken care of and they get returns, they get whatever information they're looking for. And so having the team, right? Especially, the biggest part, as you can imagine, is accounting, right? Accounting is a beast for fund management. And it's funny because I have gone through four CFOs, I want to say, in Stratus. So the fund we're talking about, I have another company called Stratus Financial, and we do student loans to pilots, and we have three funds in that. And just to me, I understand the concept, but I am by no means and never will be an accountant. I can read a P&L, a balance sheet. I can read the documents, but I can tell you how to put those in there. And so, getting the CFO, you would think, and maybe it's too general. You think, oh, he's CFO. He's had financial experience. This is going to plug and play nicely
Yeah.
into our scenario. And then the first look at the questions, and you realize, oh my gosh, this person does not understand what we're doing here. And as I said, I take emotion out of it. It's maybe I didn't train it right. And so early on with a few CFOs, I don't know if you had the experience too, is I kind of delegated more because, hey, I'm running the company. I don't know anything about accounting. CFO's got it. And that
Yeah.
abdication, is what I'll call it, was really a mistake. Making sure he understood at least the concept. And then if they understood the concept, they could take that concept, hopefully was a key word, and translate it to what the accounting practices were doing. But as you know, those practices, not the best.
Well, yeah, I mean, pooled fund accounting is a specialized portion of, I guess, like the comparable thing in the law, right? There's general law, and then there's very specific things on very specific topics. It's the same in fund accounting. I mean, it's really challenging. So at this time, yeah, right, and we're talking the mid-teens, right? You've got a sizable law firm and growing, you're running conferences, you're doing funds. Like as an entrepreneur, how do you manage all of the different component parts of the multiple businesses and keeping them straight? And what's that experience like?
It sounds really cliche, but I hate cliches. Even though it's funny, the older I get, the more I understand them. But it's
They're
really comes
cliches
down,
for a reason.
right, exactly. But it really comes down to processes, procedure, and people, right? But it's a lot more than that, in the sense of, yes, you've set up the systems, but do you have an accountability system on top of that, right? Do you have, I don't want to call it hierarchy because it can be a flat organization system, but do you have checks and balances? Do you have redundancy within your organization? And that, by the way, when you build all of that and you get the right systems and things in place, that allows me to spend less time in a business. And to me, at least, that's a goal, right? I want to build businesses, and I love things, but I'm a visionary. At the end of the day, I love to dream. I love to design. I love to create stuff, and that's my passion. So pair me with someone who can execute, and that's a dream come true for me. But I'm going to go dream while they continue to execute the business. I'm going to figure out the new next best thing. So
Yeah.
that, or we're going to work on the biggest problem, because I do believe in that as a CEO's role, is I'm going to go to the number one problem in my company and go fix it. And I don't know who I
Yeah.
need to come and pull together to get it fixed, but we'll make it happen.
Yeah, and so I know that then in the not too distant past, like you've now kind of split off the original firm that you founded, started another law firm and still running the fund, but you're also now you've got a new series of conferences. So kind of what are you up to these days?
Yeah, yeah. Back to that, if I want to dream it, if visionary, I wanted to, if I could add something new to the conversation. I don't know if I'd have a conference line again, but I was looking at everything out there, and these guys are a lot of my clients, so I say it with a lot of love. The securitizers, guys who are really killing it with, of course, either warehouse lines, forward flows, whatever they're getting, and they're originating millions and millions of dollars a month, right? Those guys, there's always a capital markets panel at these conferences, which is awesome. And then, of course, what they're trying to connect to is brokers, right? So you got broker conferences, which is also amazing. But the person I think who have gotten lost in the shuffle, so to speak, is at least the person I've always known as a hard money lender or private lender. But I referenced it 20 years ago because these were the lenders 20 years ago. Is that what we call now balance sheet lenders? The people who have funds. It doesn't have to be huge. It could be something like 40 million. It could be 500 million. I got clients who I'd still consider balance sheet lenders. They have no interest in securitizing their loans. They just want to hold it. Who have $2 or $3 billion.
Yeah.
And
Yeah.
I want
So
all
is
these people
that
to connect.
so that's the focus for some of your newer stuff is like the balance sheet lenders, the fund managers that aren't actively selling the paper off into the secondary market.
That's part of it, but I wanted to create a space for them. So definitely with our conference line, Activate, they've got a track. Brokers have a track, and securitizers have a track as well. I don't want to ignore the other two. I just don't. I just think the balance sheet lender is underserviced. But what if we brought all three pieces into the same conference? And of course, they have different educational tracks because they're going to care about different things, right? A broker's not going to necessarily care about, okay, raising capital, because all he wants to do is where's the next lender I can send a deal to and get paid.
Yeah.
Balance sheet lenders not trying to securitize, so they're not looking for a capital markets panel. But if they all have three separate educational tracks, but then they all come to network together, I mean, the entire ecosystem is there. To me, that seems really amazing. And
Yeah.
that's the goal in the February 2026 conference, is to get all of private lending there in whatever capacity they plan on being there, and networking together.
Yeah, so let's segue into the REIT conversation. I know that for balance sheet lenders, a lot of them, right on the mortgage pool side, they're eligible for becoming a mortgage REIT, although I know there are limitations there. I know that, correct me if I'm wrong, but I know you've done a lot of REIT
Quite a
work in
few.
the past, and I know there's confusion out there. I get this question often. When does it make sense for somebody to maybe just give us a brief understanding of a mortgage REIT when it makes sense, the high overview, and then we can dive into the details a little.
Yeah, absolutely. And I'll start with basic. I don't know everybody's educational level, but the benefits of a mortgage REIT for investors is they get that qualified business income credited. 20% of the qualified business income comes off taxes. So think like a 20% discount on interest earned on the fund, which is huge, right? If you're getting a 10% return, you're only paying taxes an 8%. So that 2% is free, almost like a 2% bond, if municipal bond you got for free. Put that analogy that way. So huge tax benefits for investors. So I can tell you, if you what translates to is if you give benefits to investors, it should be a lot easier to raise capital, as you and I know, Matt. If you gave him a 1% tax rate, you'd raise billions of dollars easy. Obviously, we can't do that, but that the REIT is going to be advantageous over, say, a traditional fund that cannot offer them that 20% credit. But I like your question: should everybody do it? And if you're just starting the fund, you're raising your first 1 to 5 million. My answer is absolutely not, right? I think you should actually get something underneath or have a path. If you have that path already, then that's great. If you already have a plan, you got soft capital raise, you can start a fund from scratch. That's not a problem, and start a REIT from scratch. But if you don't have that plan, if you don't have that, what do you want to call it, that acceleration effect, that snowball that you've been doing it a while, and now you're ready to throw deals or loans or whatever into the fund, then may not be the most appropriate. But
Well, I know that there's some downsides to the REIT from the manager perspective, right? The cost being one of them because it's more expensive, right?
oh, cost, yeah, and this is not downside, but definitely something to consider. With mortgage REITs, you have to distribute 90% of the taxable income as dividends. Now, most of them already do 95, 99.
Which people are already
Yeah.
generally doing anyway, right?
Yeah, exactly. But there's no option, right? If you wanted to save for a rainy day, I don't have many of those, but I do have those conservative people from time to time. I'm saying you don't have this option with a REIT. You must do it. So
Yeah.
there's no saving that. But yeah, no, there's and then of course the 100 investor rule, right? Which we can help with. But yeah, you have 100 investors you're managing within the REIT structure as well.
Well, in other words, there's a requirement in a REIT that you have a minimum of 100 investors. So if you're starting a fund from scratch
Right.
and you don't have any investors, then you really can't do a REIT until you have 100. Now, there's ways to deal with that, correct?
Correct. Absolutely. But then
Can you
that,
describe
as you
that a
imagine,
little?
I'm sorry.
Can you describe that a little bit?
Absolutely. So what we do usually is we can make it a preferred return within the fund, and so we get 100 investors, and we get a small dollar amount, say $1,000 or $2,000. And what they do is now they're in preferred equity position in the fund, so they're above your common stockholders, which is generally either your other fund in a sub REIT or just the other investors in a normal REIT category. And so they're feeling protected, right? You can imagine in a $10 million fund, for instance, is using numbers, and you got $100,000, you'd have to pierce 99% losses before that little protection there. So 100 investors would love to get 12% return, even if it's just a little bit of money on virtually no risk. And I say virtually because we can't say there's no risk. There's always risk in these things. But no, that's the way around it. But as you can imagine, there's other rules we have to comply with. So there's another rule called 5 and 50. So no more than 5 people can control 50% of the shares of the REIT as well. And so as you're starting out, that becomes problematic until you get some snowball effect of capital raising and diluting the control people within the REIT.
And then what are the requirements of the manager to make sure that they're adhering with those rules?
Oh, sure. Several, right? I mean, they have to file every year the REIT paperwork, which you obviously hire someone like yourself, Matt, to manage the fund, hopefully, because there's a lot of accounting paperwork that goes with that. You are going to also have to make sure you don't get to dealer status. So that's a real concern, right? If you are buying and selling paper, so you'll see that maybe you're accruing it and then securitizing it or trying to do a forward flow. A REIT can't participate in something like that. The REIT's purpose is to buy and hold wherever it is. In this case, we're buying and hold mortgages. We can create structures around that, but within the REIT itself, that would be prohibited.
So can they sell anything, or is there a threshold, or do you just flat out cannot sell loan? Because I know a lot of managers and even fund managers, a portion of the paper, you're underwriting it to somebody's standards, and if you wanted to, you can turn around, sell that paper, and generate a yield spread premium,
Yeah,
right?
there's
But in
no
a REIT, you can't do that.
Yeah, well, there's no hard and fast rule as far as if you do it once, right? The question always comes down to purpose. Why are you selling it? Are you trying to rebalance your portfolio? Probably okay. Are you doing it regularly? I mean, this is part of your strategy of, hey, we're going
Yeah.
to sell it every month. That's going to get you into dealer status.
Yeah, and if you're in dealer status, then at that point, it blows the REIT
Uh-huh.
election, which means it's no longer a REIT. And what is the consequence to somebody if they do that?
Oh, you've told, yeah, I'm assuming you've told them their REIT, and obviously we'll disclose otherwise. But yeah, now that qualified business income, that 20% is gone. There's also penalties as well. I can't remember off the top of my head, but there's about tens of thousands of dollars of penalties that go with that as well.
Yeah, so bottom line, you don't want to make that mistake.
Not at all.
Yeah, and then from a pure structural standpoint, I don't get too deep in the weeds, but the REIT itself is typically a separate entity
Mhm.
than the fund, right? So you have a sub-REIT, the 100 investors come in at that entity, the fund is the investor in the entity, and you're raising money from your other investors, your common LPs,
Yep.
right, at the fund level. And the fund is investing into the sub-REIT, right? And the 100
Got it.
investors live at the sub-REIT. Is that
That
basically?
that's the basic design, and that solves a lot of those things we were just talking about, right? So if you want to go create that forward flow we were just talking about it, keep it at the fund level, not in the sub REIT, right?
Yeah,
That's who's there. The sub REIT can only do REIT items. So you could whatever you plan on buying
yeah.
and holding could go to the sub REIT. Anything you want to, I don't know, securitize or forward flow or move
Yeah.
around a lot often can stay at the fund level.
But that in that scenario, you have two separate entities that you're managing, and those entities are filing separate tax returns,
Yeah.
right? They're having to be tracked separately. So from a cost standpoint, it definitely increases overall cost. Typically, those costs are fund expenses,
Yep. Oh,
but in order
100%.
to make, justify those costs, right, you need some amount of scale.
You absolutely do. And Matt, as you and I have been around, right? Think about just the accounting lift on that. If you have even I would say a modest portfolio, say 50 loans. At a minimum, I'm assuming their monthly payments. It's 50 payments coming in one account. And then you got to track that. Is it interest only? Are they paying principal? You're going to pay downs, you're going to rollovers. Setting up the books for to become very organized is cannot be overstated, right? I mean, Matt, you know that better than I do, but I can tell you just from experience also, what I've seen in some of our issues has been, even though we set up the books correctly, the systems processes weren't followed, they became ignored, and then you get the problem with that is if you don't get reconciliations, if you don't audit it monthly, even you don't see the snowball effect till you're getting down to your audited financials, which is a headache.
Yeah, no, yeah, no, you don't want to do that at that point. Having seen a lot of your clients setting up and running funds and then having done it yourself, obviously you're in and around the world of raising capital. What's your thoughts about, how people, what they should be thinking about in raising capital to be successful as a fund manager? I mean, doing it one deal at a time is one thing, doing it in a fund format is another thing, right? Who your investor base is, all of that. But I know you got a lot of experience there. Just give us some high level thoughts on that.
Yeah, well, I'll give the basics, and then we'll go from there, right? So the basics always comes down to the person who's running the shop. Obviously, you are, or whoever's doing the fund. I think that can't also be overstated because people invest in people that don't generally invest in deals. At the end of the day, you know, if I invest in Matt's fund, it's like, can I trust Matt? Is Matt going to do the right thing with every deal? And things are going to go wrong. It's a business like anything else. Will Matt be there when things go wrong? So they invest in you. That's first and foremost. So obviously polishing up, I would think polishing up your bio, having the experience necessary, right? Whether I don't even necessarily mean fund experience. Being a new fund is fine, but are you experienced in whatever you're trying to sell into the fund and to investors? Have you been doing it a while, right? And education, I think, is paramount with a lot of investors. I can tell you, and Matt, you've probably done this as well. Questions like they'll ask 20 questions, not generally about the ppm but just about the industry itself and everything. And you can see if you leave that to maybe a junior person, they may turn off an investor because they don't have the knowledge. And investors may say, hey, you're not answering my question, I don't feel comfortable with this, and they leave, right? So getting those people in the door is all like getting your borrowers in the door, right? Just as important. But I still consider that basically basic stuff, right? Most people know that. So what's next from there is getting a team around you. The things that I wish I did differently also in running a fund is I took everything in-house, and I think there's a lot of good in that. I definitely believe in origination in-house, right? Because the way I see things may be different from others. But I'd hire professionals, accounting in particular. Like it can't be understated how hard it is to hire for accounting roles in this type of say fund experience. Because even if you think you've got CFOs with financial experience, translating that into, hey, I've got 100 transactions here of various things, could be interest, could be income, could be partial pay down, and getting a strong operator from a CFO role that understands your business, it's tough. And
That's tough.
my thought would be outsourcing that. And then, finding other pieces of the team that you can outsource, and that frees up your time to really concentrate on what you do best, which is originations.
So as you start your latest gig and your new firm and all that, what's kind of next on the horizon for you in terms of what you're looking forward to?
Yeah, no, I mean, I think funny enough, and it's become even bigger than probably when I started that I thought private lending would ever become. It's, sitting 20 years later, it's crazy how big the industry is. But I could say sitting here today, I think we're still just beginning. Here's my thoughts. Securitizations are here to stay. Securitizers are here to stay. They've optimized, residential transition loans, what we used to call fix and flip. They're optimizing DSCR. They're optimizing these other categories that once you build the process, right? If you become McDonald's, you build the whole process to make it faster, cheaper, stronger. That's right for optimization. Where does that leave everybody else? And of course, if you want to play in the securitizer playground, that's where you'll live. But then if you're still like a balance sheet lender, for instance, then RTLs may not be as profitable. You really need to go find the other esoterics, other niches that'll make you get the yield that you and your investors are expecting to be returned to them. And so, I say this, and we're going to see a huge expansion in private lending. And I'm curious to see how much we'll continue to take out of bank business. Because one of the things I think private lenders have been amazing and always great to do is they close quickly, right? Banks always take 60, 90 days. And honestly, I don't know if you guys have been doing it well recently, banks keep on taking longer, right? There's more and more paperwork, more and more regulatory oversight, more red tape. Can you count on
Where does the securitization of these residential loans, because it's like the more homogeneous you can make them, the easier it is to securitize. Where does that leave the balance sheet lenders in your estimation in terms of what kind of deals they're able to be able to be competitive and to do with the private lending?
Yeah, but breaking it down into the most basic level, what securitizers are really great at is they draw a box around whatever they're doing. So RTLs, for instance, here's the box. These all look the same in this box, and we can sell it because it's predictable, right? You can't securitize what's not predictable. So once this whatever element is predictable, that really becomes something that balance sheet lenders not going to be able to compete against, right? Because you saw it. You saw it when RTLs became popular in 2015 all the way to here. What was double digits, you're now starting to see in single digits. And even, I'm seeing sevens and eights, for good borrowers. And so, as you can imagine, returning investors after the cost we just talked about in running a fund, right? Your audits, your things, like you're going to return 4% to investors.
Yeah.
No investors sticking around for that. So you've got to generate a yield they're going to be attracted to.
That's right. Yeah. So what does that leave? Like commercial loans that are maybe not your standard sort of debt coverage driven life company type. So commercial hard money.
Yep.
It's funny. I was in New York last week. I was talking to a guy and he's been in the business a long time and I called it hard money. He's like, no, we call it transitional lending now, not hard money.
There we go.
So, but yeah, hard money, private money, whatever you want to call it, right? It's like, it's still a big business, but to your point, to be competitive, you can't be trying to do these loans that securitizers are buying up.
Yeah, and so you've got what's next and what's out there. And I know you've seen a lot as I have. A lot of my clients, they're really creative, and some of the stuff they create just amaze me as well. But what I've seen a lot of right now is construction is coming back to the private lending space. Ground up even. We've had some tragedies, of course, in California and elsewhere, giving some opportunities to get that ground up construction again. I haven't seen it come back, but I can tell you, I saw it in '09 was hotels, even for private lending. I saw first, seconds, and thirds on hotel lending. Don't see too much of that nowadays, but I think part of this will be as those boxes keep on being drawn by securitizers, and that's taken out of the balance sheet lenders' hands. You'll see them get more and more creative and expand elsewhere.
Yeah, seconds and thirds are going to be hard in California now, aren't they, with the new law that passed?
Yeah, so AB 130 passed in California, basically saying this. They put it on the onus of the servicer. You now have to declare a penalty of perjury. Over the last 3 years, the borrower got all the notices of the past 3 years. It's insanity. I mean, the laws that they have there is just you've basically effectively now chilled seconds and thirds. There's some associations out there challenging AB 130, so we'll see where that goes. But yeah, now it's just very uncertain.
Yeah. Well, as we get to the bottom of the hour, if anybody has any questions, please type them into the window. As maybe give us a little heads up there, Anthony, on your upcoming conferences you got here after the first of the year.
Yeah, I would love it. So, the website is www.geracievents.com and GERACI. We've got what I call a hybrid conference, and they're actually two separate conferences that really are back to back at two different hotels. It's called Elevate and Activate, and the purposes are very different. With Elevate, what we're trying to do is to expose people who have never seen private lending from a broker side to private lending. So real estate agents in particular come to mind, or anybody that has at least thought about it, but they already have deal flow, right? They already have real estate deals and everything, but they may not be monetizing it. right? They may not be sending in the commission to get loans on this particular deal or something like that. The way they could now double end that in such a way that, hey, not only did they sell the real estate, they also got the loans and private lending as well. Or, if their seller or buyer, whoever they're representing, oh, well, they can't get a loan. Well, here, now I have options to send to you. And so this Activate, really introducing people who have never been exposed to the private lending industry, what private lending is about. So that one's going to be very much teaching or panels, and we've got some great private lenders coming to teach them about private lending in general. And that's 2 days. And that's, I think, February 24th, 25th, and the bottom of 26th. And that rolls us into Activate on the 26th and 27th. And that's kind of what we were talking about earlier, which is the conference that I want to bring in the entire private lending industry together, whether you're a broker, balance sheet lender, or securitizer. We'll have 3 separate tracks of education of stuff you care about. But then, of course, there's going to be shared networking. You may want to meet a broker or a securitizer. Maybe there's different areas you want to break into. I'm excited to have everybody there. We're anticipating 400 people at that conference.
Cool. Well, that sounds good. We'll definitely be there participating with you. And if anybody's interested, please go to that website. It doesn't look like we have any questions here, Anthony. So I appreciate your time, man, and it's good to chat with you as always. We'll definitely catch up here first of the year. So thanks for being with us.
Thanks for having me. Always fun, and thanks for doing this. Always great to catch up with you as well.
Yeah, of course, my pleasure. So thanks everybody for being here. We appreciate you guys coming here once a month, and we'll have our next webinar coming up here in December, last one of the year. Working on that one as we speak. We'll get the dates and the guests out to you here shortly. Thank you so much for being here, everybody. Anthony, thanks for being here. We'll see you next time.
Appreciate you guys. Take care.